Teamwork. There you go.
Right, guys, we might kick off, and if anyone else joins, we can we can take it from there. I mean, small group is quite good as well for this sort of stuff. So, evening everyone. My name is Will, and this is my colleague Hannah. Despite it saying Frolo on her on her tag there on her window. Um, so look, this evening we're just going to have a general chat about financial planning, maybe give a few ideas and a general overview of some things that you should be looking at. It won't be terribly academic. I suppose it's predominantly for those based in Ireland, but I think there'll be other themes that will be kind of present in the UK as well. Um, so kicking off, I suppose the title of this talk, and we do this talk a fair bit, is being money fit, and the whole reason for that is that I suppose likening it to fitness and diet and nutrition is that good simple habits over time create good things, create wealth, create proper good financial planning, those small little micro habits. So this evening, what we're going to do is just basically introduce ourselves shortly. Hannah's going to take you to some ideal structures and habits that a few different scenarios that maybe maybe you fit into one of those boxes or not. I'm going to walk you through some top random tips that we have, no particular order, but just might get you thinking. And then we're happy to kind of open it up and answer any questions specifically to you guys. In a few minutes. So look briefly about our business. SparksWealth is the name of the business. We founded in 2019. We found that within the Irish market in particular, and also relevant to the UK, is that there was a lot of what we call cowboys and got kind of a very sales sort of orientated industry. So we want to put a bit of science, a bit of maths into that, and make our recommendations exact, and not just be about brochures and trying to sell something to our clients. And then the second piece of that was also just to help, and I think we're quite good at this, is just diffusing all the different jargon that exists within our business, which I think is to give the likes of myself a big ego. And diffuse all that and just present it in a nice way that people understand. And then lastly, and I think this is definitely relevant to us all, is just encourage living and spending for the moment. We're not the type of financial planners who will put big red marks through your spending and sort of say that you shouldn't be doing this and you shouldn't be doing that. I think we're all about just creating simple, basic habits that are viable and have longevity. So we're all about good holidays and good experiences, and especially for you guys with your kids. I think it's super important. I won't bore you too much about me. It'll be on the notes afterwards. Others say they set the business up in 2019 and been in the industry for far too long. And I thankfully now have great colleagues. Hannah is our head of financial planning, and a bit of a superstar in this field, as you'll soon hear. So Hannah's going to be talking through the sort of next part of in a second, and you'll be hearing a lot more from her. But others say that just you're in very capable hands with Hannah.
And with that introduction,
there we go. No pressure.
Exactly. And look, there's just we have a slide here, just if anyone has the phones handy as well and just want to check out our website. There's a QR code there that'll bring you directly to our site, just so you can have a nosy as well, a bit more about ourselves. And there's also resources there to book directly into us if there is anything a little bit more personal you'd like to talk about, you don't feel comfortable mentioning in the Q&A after this as well.
And we're moving from website A to B. We've a new website, so it is a little bit under construction. So apologies if you are on a show this week.
True. So similar to what Will actually touched off earlier on, I wanted to start off the slides with a little quote from Aristotle. We are the sum of our actions, and therefore our habits make all the difference. This is kind of from the very journey of life. You're always told, practice makes perfect. If you study throughout the year, the exams aren't as hard. If you stay fit and healthy, throughout your life. You tend to live longer, etc. Well, it's very much the same when it comes to savings. So when you get into the right habits from an earlier age, you tend to have that little bit more financial freedom, a little bit more wisdom about you as well in terms of your savings and the comfort in knowing what you value and kind of your long-term plans and your what you hold close to yourselves and the way that you save towards those things as well. So I just thought that was a nice little phrase there and kind of the motto throughout this meeting as well, for some of the advice that we'll be giving out throughout today's webinar. So one of the first questions we tend to ask clients or ask them to have a think about more so is, what am I saving for? So naturally, there's the kind of short, medium, and long-term time frame that we have when it comes to savings. Some things are more of a priority. Some things can be put in the back burner to a certain extent. So when it comes to starting off your savings, you have to kind of think about the timing of these things as well. Do I have 3 years to save for something? Is there something I need to pay off on a monthly basis? And once you have those kind of goals in mind, it's kind of, how can I start this saving then? We have a couple of styles of saving there kind of at the top, and it's kind of in priority. So the best way to start saving is through a direct debit. It takes the thinking out of it. It's someone else going in, taking whatever the amount is out and putting it into that little structure for whatever that goal is, whether it's towards a car upgrade, or the kitchen needs to be done again, or third level education for one of two or three children. Direct debits are key here. If maybe we don't feel comfortable having a direct debit set up every month, there's always the other options like standing orders, which is similar enough, but you're kind of in the driver's seat of what's coming out. And then there's, of course, the manual transfers, whereby you kind of sit down on a monthly basis, or however often you're paid, and you see, right, what's left at the end of the pay slip, basically, and manually transferring that into the structures necessary, whether it's credit unions, vaults on your Revolut, whether it's on Plus accounts, whatever structures you already have set up there. And then last but not least, if again someone finds they're fairly, strapped for cash towards the end of the month, what we recommend is having an ideal figure in your mind. So kind of, I sleep easy at night knowing I have X amount in my current account. If at the end of the month, when you're due to get your next pay, if there's even €20 above that kind of amount, it's manually putting it somewhere else. It's not getting too comfortable or too used to having more than what you feel you need for this particular structure. So it's kind of having that attitude of, I know what I'm comfortable spending. I know I have these goals in mind to save towards. So I need to make sure any bit of overage I have each month, I'm putting into one of those pots. And kind of on what Will had said there, that could be going towards Christmas. It could be going towards a lovely holiday. It doesn't necessarily have to be this, long-term stringent plan. It can just literally give you that little bit of reassurance, knowing that when a holiday does come up, you're not worrying, or you're not looking to take out a last minute loan or anything like that. So after we've kind of established what these goals are, that's when we kind of talk more so about the time frames. Keeping it very, very simple, our Sparks Wealth strategy is called our pot strategy. So if you can imagine, obviously, like I said, we short, medium, and long-term goals and needs. Very much so, the short-term pot is the first one that we want to make sure is comfortable. You need to know that you have enough cash in your current account to support your ongoing expenses, that if there are any known expenses coming towards the end of the year, I say Christmas all the time because you always end up overspending on Christmas, that last minute guilty shopping, buying for all the in-laws, etc., that you don't expect to, you're not expecting to see, but then suddenly they're going to be there. So this is the kind of pot that you just want to make sure there's enough cash in there essentially to keep yourself comfortable, to be able to go out on that, to go out for dinner with your friends or whatever the case is, and also to be able to look after those expenses we know are coming our way in the next 2 or so years. So in terms of, you'll see at the bottom there, kind of risk, the word risk is highlighted. That's essentially saying no risk. Keep that in the bank, keep that in the credit union, keep it somewhere where if you go in today, you can access the cash today without stress. Okay. Then we move on to our second pot there. Time frame wise, we tend to highlight it's about the kind of 4 to 7 year, frame. Some people call it their 5 year plan. This is where we tend to talk about the likes of medium risk. All we're highlighting there is anything you have in your cash account is kind of valuable now, and it'll kind of hold its value, for argument's sake, for the year you expect to spend it. Anything beyond that time frame, we're all no strangers to inflation. So it's all well and good keeping cash in your bank account and seeing the figure remain as it is. But when the cost of our shopping is going up, when our bills are going up due to inflation, you have to make a little bit of leeway for yourself then for, that medium term. So this is kind of exploring structures that might be more suitable for that slightly longer term savings, Nothing too adventurous, nothing wild and wonderful. Very much kind of what Will and I jokingly say is these kind of boring little structures that are, like that, a direct debit that's going into a pot, but the goal behind this particular pot is holding its value. So you need it to be, or you'd like it to be earning, 3, 4, or 5% bit of growth on the side to just to keep and retain its value that you used to have in pot one, basically. And then moving on to our third pot there, we, again, for this model, we kind of say a 7 year plus. For many people, this is kind of their 15, 20 year plus plan, i.e. their pension. So if they're paying into a bit of a pension at the moment, they can kind of breathe and say, okay, I've got a little bit going into my pot three already. My pot one is getting there. I'm getting to that comfortable, saving amount. So now I feel, or maybe next year I'll feel comfortable looking at that pot too. So it's kind of just going back to, your pots and your stove. You don't want one pot bubbling over and then two more, the other two burning at the base, there's nothing in it. The goal will be to have the three of them simmering away with a little bit in them. And like that, you get to prioritize them as your lifestyle requires you to as well. Okay. And also, I should mention there, when I say the word risk, that'll be something again we would kind of touch base on a one-to-one basis, but it's just talking to you about potential structures, saving structures out there that might like that work a little bit harder for you than your typical bank structures that are available. Some examples of those pots that I briefly went into earlier, children's education. Unfortunately, it's always the on the back of our minds, and the cost of it's constantly going up. I'm always seeing these budgets coming out, and I like to say Zurich highlighting the average cost, and it can be between 7 and 15 grand, a year, depending on whether they're staying at home, if they're going, depending on what course they're going to do, how many years they're going to be involved in it as well. So it's just kind of knowing, right, if my child is 4 or 5 now, I have give or take about 10 or 11 years until they're going to need this college fund. So is it much easier for me to save a little bit amount, a little bit each month now to satisfy that goal rather than they get to 17 and you're panicking now thinking, how am I going to get them through the next, couple of years? So this is one of the big posts that we tend to see clients come to us about saving towards. Then there's the lovely early retirement career break pots as well. I find this is a massive one, especially for women. If you ended up taking a bit more of a longer break off work after maternity leave, if you ended up going back and doing part-time work or job share, that tends to impact, obviously the ability that you had to save towards the likes of pensions, etc. So it's just making sure we're looking out for ourselves there to bridge any gaps that we're missing in terms of pensions, or also just giving you that little bit of freedom knowing you're not going to be working until you're 70 or 80. So it's always something that we tend to look into kind of sooner rather than later. Bank of use, similar to the pot one there, this is the most important pot. You always want to make sure that you have that pot comfortable and you feel secure in it. There's enough there to cover emergencies, a little bit of a slush fund, and like I said, the big ones are Christmas and your annual holiday. And then I always just popped in another one there called later life. And essentially that's kind of you get to retirement, and what happens then? A lot of people just say, I can't wait to get to retirement. But what actually happens at retirement? There is a state pension there, that you'll chat about. But will that give you the lifestyle that you'd like in retirement? And sometimes what we don't think about, we're so focused on the now and looking after, looking to pay for everything that's so expensive now, and the kids are expensive, etc. We tend not to think about that kind of, oh God, if I get to say 70 and if I'm not well, or if I need extra care, how much would that cost? And am I going to be able to pay for it? Is that going to fall on my kids? So it's just kind of having these difficult enough conversations, but sometimes it only takes that one conversation and to flick a switch sometimes to say, okay, I think if I have those three saving structures in place, one should, the longer term one, that should sort me out in terms of pre-retirement, retirement, and thereafter as well. And going back to my time note earlier on, the sooner you start those plans, the better and the easier it is as well towards the end. So saving is obviously what we just kind of mentioned there, and the idea of saving is far easier than it sounds than it is to do. But you can't concern yourself massively with starting all these savings when there's also these risks that you have to kind of look out for. So sometimes, again, talking about that difficult conversation that we always tend to have with clients on like a Monday morning, it's the worst timing to bring these to the table, but it's just to kind of have a look at those what if scenarios. So anyone who's working, they might have a level of insurance through their work. So if they were to pass away, there's some sort of a lump sum paid to their beneficiary or the next of kin, and that should sort the children out in terms of finances for a few years as well. So it's always worth exploring those avenues, really setting out, okay, I know exactly what I have, and I either feel very comfortable with that level of security, or I don't feel totally comfortable with that. I would love to put an extra layer of protection in here just in case something was to happen. It could be, like I said, passing away before your time, or it could be getting ill. No one ever wants to get ill or expects to get ill, but when we do, sometimes it can really, debilitate us and cause us to not be able to work for longer than expected, etc. So again, it's never a bad idea to sit down and just evaluate what you have, what the state can offer in those scenarios, and if you feel you need to cover yourself a little bit more. So these are one of the first conversations we tend to have with clients. So I kind of touched off it there in my last comment there, but just in terms of regular income. So naturally, savings, you need your income. If your income stops, we can't save. So it's just a matter of making sure there's a level of protection there. So if we can't work, there's some sort of an income coming in, or like that, you have your pot one to an extent that can cover you for a couple of months if you can't afford to work. Okay, so these are the kind of bones behind some of those figures that you might think about in your pot one and your pot two. And naturally, prioritizing all of these savings, as I mentioned earlier. If anyone's currently renting and maybe their main priority is building up a deposit for their house, absolutely focus on that. Don't worry about the likes of, well, I have to save into, I need my money to start growing and I need to start saving to pension. That will come. If your main goal right now is to get yourself a house, do everything you possibly can in terms of the savings. I think the habit is the main thing there. And once you succeed and you get your house, you're already in the habit of that saving. You were already putting your 100 quid, a month into your credit union towards the house. Now you've got your house. Don't get me wrong, the expenses don't just stop when you get the house, but at least okay, I don't have to, have that clean transaction towards savings for the house. I can now revert that over, and I might pop a little bit of that into my pension now actually. And look, I feel like I'm comfortable with the pension contribution now. I might start looking into that pot two option that Hannah mentioned. So it's just, not worrying about trying to do everything, because again, some things need more prioritization than others, but it's just a matter of getting yourself into that habit of saving towards the goal. And once that goal is achieved, or halfway there, starting to look at the other options then, or the other structures that you want to start saving for over the next couple of years onwards. Yeah. So then I think, Will, you've got a couple of top tips then to go kind of in conjunction with what I've said there.
I do, and in no sort of particular order here. Again, it's just to get everyone thinking. Child benefit. I know it's slightly different in the UK, but the same principle stands. If you were to stick away €140 a month of your child benefit for 18 years, and you're to get a 7% return when your child was 18, that would be worth about 61K. So I think, again, just more further example of building those habits. And I think if we never felt that 140, if we never spent it, then putting it away and setting up a direct debit into an investment account makes a huge amount of sense. And again, like I would consider that to be a very small, uninvasive habit that can really create good wealth over time. So you've got a nice fund for your kids for college potentially. Hannah kind of covered this next one, which is just the single-mindedness of especially a house. And I don't think it's as tough in the UK, but certainly in Ireland, it's an absolute mountain to climb to get a mortgage these days. And I would just, as Hannah alluded, just put all your effort into that. Just be a bit single-minded for 12 months, 18 months, and you can get back on the savings train after that.
Mhm.
This definitely applies both sides of the Irish Sea. Is just the starting that mortgage process early is so important. Um, Start it before you need it. Again, it is a mountain to climb. They're going to want to know how many eggs you have for breakfast, and you know months of bank statements and all that kind of crack. So you start early, before you even start looking for houses would be our advice there. Um, I'd say this is a very Irish one, which is not keeping up with the Joneses. I think the reason I put that in there is you do get it a bit of people looking around and going, how can they afford that house or whatever. Envy is not a good sin. It's an idle mind. Charlie Munger suggested that it's the only one of the deadly sins that you can't have any fun with at all. But just focus on your own finances. There's always a story in behind everyone else's that makes you feel guilty or whatever. But just focus on your own. Um, this one I think is really important for the Frollo community, and this is have a good money person. And this isn't the turkeys voting for Christmas saying you need to have a financial planner. This could just be a very good friend. I think sometimes it's a bit of an old school trait that we don't tend to share things like salary and costs and rent and mortgage costs. But I think you need someone who knows you well, even if it's not a professional, to just run ideas by and someone that knows your finances well. So I would invite more talk with friends as opposed to less. I think that whole kind of private thing it went a bit too far. Um, then the last point I would make is just be a little bit. I hope no one works in a bank, if anyone here this evening, but just be a bit wary when it comes to financial planning at banks. Banks are I was about to say banks are good at one thing. They're okay at one thing, but financial planning tends to be more kind of brochure led, and generally fees and charges through a bank tend to be a bit higher. So again, just a random one for everyone there. This is very specific to Ireland and to the Frollo community. There are certain entitlements that you guys or some of you guys will be entitled to. So we've just named 4 of them. I won't go into each one into detail because not all are relevant, but certainly do your research and have a look and see if you're eligible for one or all of any of these avenues. And that's like, I suppose that technically you've had 22 minutes of financial planning talk on a Thursday evening and you've survived. So I think happy to open it up to you guys if you have any questions. We're here and we're more than happy to go into any specifics or anything like that. And if just any question would be great.
Stop the recording just so that if any questions do come up, they're not.
That's what I've got to say. That's why I stuttered. I was like, maybe we should stop recording.
Yeah, that's done now, guys.
Hello, can I ask a question? Sorry, you both look very businesslike. I'm afraid I'm on my sofa.
I'm well jealous, Philip. That's brilliant.
Yes. So I'm based in England. I'm a lawyer. I'm head of a legal for a big company in Leicester where I live. Actually, they've got branches in Ireland, Dublin and Belfast. So I'm obviously regularly speaking with my Irish colleagues. So I've been a single mum for 7 years. Left a very unpleasant ex-husband living in Luxembourg with my then 8-year-old twin daughters who are now verging on 16.
Good on you, Philippa.
Well, good on me, but in the process of a 5-year divorce, and we lived in Cardiff for many years. It's no exaggeration to say, and hi, the other people in the group, that I probably am down £750,000 over the course of loss. And I think, I'm only quite new to Frollo, but yeah, financial loss for me as a single parent has been massive. And part of, if you're in that experience, part of what you suffer or may suffer if your ex-husband is a narcissist and wants you to have no money. So anyway, thankfully I'm not in that position now. As I said, I'm a lawyer, so I've been able to rely on my profession to get me back from having nothing in the bank and living with my parents for a year and being in the job centre to being we have a house now. Anyway, I have a financial advisor. I have money in the bank and I don't spend any of it. So I have money now. And my financial advisor, who also says to me, this is the problem for the place, is you don't buy anything. He said, because the fear factor.
Yeah.
Well, we went from we're both working in Luxembourg, earning almost €500,000 a year, and then I left with a suitcase and no penny, and all our savings had gone to move. Anyway, it was very, 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 very complex. So when you've had that fear factor of having nothing, we buy all the food with yellow stickers on in the supermarkets. And that is the reality for a lot of people all the time. So my financial advisor is probably slightly less conservative than what you're advising, you know, because he deals with more high wealth individuals, but he's a friend and I trust him. And he's like, you can, you know, he said, whiskey and water, Philippa, you could mix some of these risks, you could take a few more risks. Lawyers are naturally quite risk averse. And a lawyer mum who's had no money becomes very risk averse. But this is 7 years on now. And whilst my ex-husband, he still lives abroad, he didn't pay any money for his daughters for 3 whole years. He pays the bare minimum. And I have no idea that he will pay any more. So I really like the idea of getting started with actually saving, because I've just got I've got 60 grand in an account with like 1% interest, and but I have to see it for my own security. So I know that might sound quite crazy to you all, but that can be the single parent journey, or that's my single mom journey.
Yeah.
And so I know that I should be putting that into other places. I do have ISAs for my daughters, so they've got ISAs. And I don't know if this is a thing in Ireland, but they had, when they were born in Wales, like 16 years ago, there was £500 trust fund, which now is with some investment company called, I don't know, Columbia Threadneedle. And I did hear that in the UK, I don't know how it is in Ireland, you can, if you've got an ISA provider, you can get them to get that money out back into the ISA, because it's just floating around in some random account. But yeah, I suppose that was a very long-winded way of saying, how could someone who's saving averse but likes to see the money that they're available, encourage some spending. I say this, we're going to Turkey next week, so I do spend some money, but nothing on myself. Nothing on
That's
myself.
the holiday we mentioned. You all need a holiday, absolutely.
Yeah, so we have got a holiday, but how can you kind of dip your toe into savings and taking a little bit more risk when you've been through this experience?
I would say having a think about, though, even like the 3 pots that I mentioned there, as in what is your figure that you can sleep at night knowing is there. Now right now it might be that 60 grand, as in you've gotten used to it now and that's your safety net, and if so, that's fine. The best way for you to branch out would be on the monthly side of things then. So you've got that, say, 60 grand built up there, that's your security blanket. So now on a monthly basis, how about I start saving into the likes of the pot 2s and the pot 3s, €100 a month, you know, see how that feels. Checking in, like Will said, having that person, whether it's working with ourselves, we'd be happy to speak with you, or whether it is the advisor that you spoke about earlier. Not being pushed into doing more than you're comfortable with. We dip toes, you know, here, especially if it's someone's first time actually looking at this, or if they've been through what you've been through. It's starting off with something really comfortable, and you find that you get used to the habit. You don't miss what you don't have, typical phrase. And after 6, 7, 8 months, you start to see the fund kind of growing. You say, okay, this isn't as scary as I thought it was going to be. And then what we do with our clients is we meet them once a year at a minimum. Some clients would prefer their handheld a little bit more, and by God, we can do that. But what you'll find is after about 2 or 3 kind of, I'd say, years of seeing the savings build up, it'll be slow growing, but you're not looking to make millions overnight. There's some investors out there that maybe your advisor, like you said, has worked with, and they're looking at kind of large investments. They want to go niche. They want to not brag about the money they've made, but you know, they've gone into these mad owl funds that no one else has heard of, and that's fine. Let them do that. But for the average Joe, kind of who just wants to see their money maintaining its value, there's lovely little structures available there. And like I said, they're very transparent. There's this management fee involved in it, and that's the only fee you have to concern yourself with. There's no hidden charges. It's all very upfront and honest. And like I said, once you have that trusting advisor there, you know that it's a match made in heaven. Then it's just a matter of seeing the growth, and then once you see that one pot grow, that's when you'll feel comfortable saying, okay, I see my pot 2 is growing now, so look, I feel comfortable now. I'm going to save a little bit more. I'm going to save another 100 a month now, but instead of putting all my eggs in that basket, I'm going to look at the pension side of things now. Do you know, it's kind of just having those really day-to-day conversations. But again, I think that main thing is having a think about that security blanket that you feel you need, pot 1, and then breathing through the rest as well.
Yeah, because that's exactly it. I've got that security blanket, and so I never let it go below that.
Yeah.
I don't need that money. I earn a lot every month. I don't need that, but I'm just like, no, it's never going below that.
Yeah.
But I know that's my, you know, but I do want to get more comfortable with the savings. And I don't know, I mean, certainly in the UK, you know, the advisors generally say use your ISAs first. So as my daughters have got ISAs, and they're, well, actually from the age of 16, they can potentially do something with it now, but I've not given them those letters from the bank, but they are there for another 2 years for sure. But
Yeah.
I don't have an ISA for myself. So I've
Okay.
prioritised them.
Mhm.
Obviously, that's what a lot of parents do. But I'm beginning to think, oh, okay, well, how am I going to leave myself in this? So I don't know if it's the same in Ireland, but generally people say put stuff in ISAs because that's a better interest rate.
Yeah.
We would kill for an ISA over here, Philippa, but
Would you not have them?
that's a different. No, we don't. That's a different
Oh,
conversation.
sorry. Yeah,
Uh,
yeah. Okay, fair enough. And all trust funds.
yeah, well, no, we have them, all right, but no, I would endorse Hannah's advice there. I think that's top notch. If 60K is your figure, then be comfortable with that. I have a figure both for the business and personally that I feel comfortable with, and it
Yeah.
doesn't have to be it doesn't have to be rational.
Yeah.
It's not rational for me, but no. But I'm glad you understand that. But yeah, okay, yeah. Thank you. That's really helpful. Thank you.
No problem at all. No worries. Does anyone else have any questions or anything like that they'd like to kind of bring to the table? And like that, if you don't feel comfortable in public, you have our addresses there that you can pop us an email or book in for a little call as well. I'd be happy to speak to anyone as well on these topics. But I think other than that, then we can kind of leave it there.
Yeah, I think we'll leave there. Well, look, our details are there if you want to get in contact or anyone else. Philip, have a great holiday.
Yeah.
Sounds like you deserve it.
We're going to Turkey, which looks very nice. Yeah,
Oh,
thank you.
enjoy.
Nice bit of sunshine as things are getting colder here.
Yes, absolutely.
Fantastic.
Well, thank you so
Right.
much for all your time and attention, guys. I really appreciate it.
Thank you. It's really helpful. Thank
No
you.
problem at all. Great chatting. And look, hopefully we'll speak to you all again soon, okay?
Okay, thank you. Bye.
Thank you. Bye-bye.
Bye.